Welcome to Everything You Need to Know About Finance. Today we're doing a deep dive into Oklo Inc. The ticker is OKLO. They're in the advanced fission energy space.
That's right. And look, before we really get started, it's crucial to state this up front. What we're talking about today is purely informational. We're pulling everything directly from Oklo's own recent filings.
Exactly. Specifically, their quarterly report, the Form 10Q, for the period ending March 31st, 2025. It was filed May 13th.
Some related presentation materials too, but the key point is, this is not financial advice. Absolutely not.
No endorsements, no recommendations. We're just, laying out the data they provided. Always do your own homework and talk to a pro before making investment decisions.
Definitely. So our goal here is really just to unpack their latest financials from that 10Q, talk through their business strategies, they describe it, cover recent developments, and see what the company says about its path forward.
Giving you a clearer picture based on their official reporting. Okay, let's get into it. Now, Oklo, they're relatively new on the NYSE, right? Listed May 10th, 2024, after a business combination.
Yeah, that's right. And the filing gives a couple of recent stock price points for context. Around an acquisition date, Feb 28 this year, it mentions $33.39 per share.
Okay.
And then an average price of $23.95 per share tied to some stock withheld for taxes in March 2025.
Got it. And just before this filing, around May 9th, 2025, they had about 139.2 million shares of Class A common stock outstanding.
Right. So that sets the stage a bit on the stock side as we dig into the financials as of the end of March.
Okay, so Q1 2025 financials from the 10Q. Let's start with liquidity. How much cash did they have on hand?
Well, as of March 31st, 2025, their total cash equivalents, and marketable debt securities came to $260.7 million.
Wow. Okay, how does that break down?
It was about $90.1 million in actual cash and equivalents, and then another $170.6 million parked in those marketable debt securities.
Over $250 million. That's a pretty healthy cushion. But what about their operating results? Net loss versus loss from operations.
Yeah, that's an interesting distinction in the report. So for Q1 2025, the net loss was $9.8 million.
Okay.
Now compare that to Q1 2024, where the net loss was much bigger, $24.0 million. So technically the net loss improved year over year.
Okay, seems good on the surface, but you mentioned the operating loss.
Exactly, because if you just look at the loss from operations, the core business costs versus any operating revenue, which they don't really have yet, that number went the other way.
How so?
The loss from operations in Q1 2025 was $17.9 million. That's a pretty big jump up from $7.4 million in Q1 2024.
Whoa, okay, so day-to-day operations are costing them significantly more, but the overall bottom line, the net loss, looked better. What explains that difference?
Well, the bigger operating loss mainly came from operating expenses just shooting up. R&D costs were up about 114%, and G&A general and administrative, that went up about 170% compared to Q1 last year.
Huge increases. What drove those costs up so much?
The filing points to, well, mainly hiring more people and higher salaries, so personnel costs. Also a big jump in stock-based compensation and more spending on professional services, think legal, accounting, consulting. Pretty typical for a company scaling up post-public listing and deep in development.
Right, investing in growth. Okay, so connect that back for us. Why did the net loss shrink if operating costs grew so much?
That comes down mostly to the other income loss line item. Q1 2025, they actually earned $3.65 million in interest and dividend income.
From that big cash pile.
That $260 million generated decent income. That's way up from only $0.14 million in interest in Q1 2024, simply because they have so much more cash and securities now after the business combination.
Makes sense. Earning interest helps offset the spending. Was there anything else?
The other big swing factor was something called SAFEs, Simple Agreements for Future Equity. These were pre-IPO investment things. In Q1 2024, before they converted to stock, changes in their value resulted in a big non-cash loss of $16.8 million. By Q1 2025, those SAFEs were gone, converted. So that $16.8 million drag just wasn't there anymore.
So, higher interest income plus getting rid of that safe valuation loss.
And one more piece, they reported an income tax benefit of $4.4 million in Q1 2025. The filing says this related to deferred tax liabilities they acquired when they bought Atomic Alchemy. That also helped reduce the net loss.
Okay, let me try and summarize the financials then. They're spending a lot more on R&D and G&A, pushing the operating loss and cash used higher.
Right.
But they have a large cash reserve generating significant interest income. Plus, no more safe losses, and they got a tax benefit. All that combined led to a smaller net loss this quarter compared to last year.
You nailed it. And all this feeds into their accumulated deficit, which is, the total losses racked up over time.
And what did that number stand at?
As of March 31st, 2025, the accumulated deficit was $144.9 million. Shows how much has been invested just to get to this point.
With that deficit and the current spending rate, how confident are they about funding operations?
Management states in the filing they believe the existing cash and securities, that $260.7 million, is enough to fund operations for at least a year from the filing date, so through mid-May 2026.
Right.
But they're also very clear that their plan developing these powerhouses, building the radioisotope business, requires, quote, significant ongoing expenditures. So the current cash provides runway, but the burn rate is real and expected to continue.
Okay, runway for now, heavy spending expected. Let's pivot then. What exactly is Oklo trying to build with all this investment?
Their main goal is developing and eventually deploying advanced fission power plants. They call them Aurora powerhouses. The idea is clean, reliable energy. And a really big part of their strategy is also commercializing nuclear fuel recycling.
Right, and I heard their business model is a bit different, not just selling reactors.
Correct. They plan to build, own, and operate their powerhouses. Then they'd sell the electricity directly to customers, usually through long-term contracts called power purchase agreements, or PPAs.
Why do it that way instead of the traditional utility model?
Well, the thinking outlined is that this build-own-operate approach gives them more control over the whole life cycle, from cradle to grave, basically. They believe selling power via PPAs offers potentially recurring revenue streams and maybe better cost management over the long haul, rather than just a one-time sale of the reactor design.
Interesting. And the technology itself.
It's based on a reactor design called the Experimental Breeder Reactor 2, or EBR-2. This is a U.S. government reactor that actually ran successfully for about 30 years.
So based on proven tech.
That's their angle. They see that operating history, including its fuel recycling capabilities, as a key advantage.
And tell me more about that fuel recycling part. That sounds pretty significant.
It really is central to their vision. The goal is to take existing used nuclear fuel, what many people think of as waste, and extract the massive amount of energy still locked inside.
How much energy are we talking?
They estimate the potential in the U.S. stockpile of used fuel is equivalent to maybe 1.2 trillion barrels of oil. It's a huge number.
Wow.
So for Oklo, recycling could mean a secure, maybe cheaper, integrated fuel source for their own reactors. Plus, it could become its own business line eventually. And, it tackles the big public perception issue of nuclear waste.
Turning waste into fuel. That's a potential game changer if they can pull it off commercially. Okay, moving to what they've been up to recently and looking forward. What are the key developments from this report?
Well, a big one was closing the acquisition of Atomic Alchemy back on February 28, 2025. The price tag was $28.4 million in cash and stock.
Atomic Alchemy. What do they do?
They're focused on producing radioisotopes. These are materials used in medicine, industry, defense, even potentially AI and advanced computing. Oklo sees it as a way to leverage their nuclear expertise in a different, growing market.
And how fast are they moving on that front? Any revenue expected soon?
The plan they described has two main projects. The first, called Abundantia, is more of a demonstration phase, setting up labs. They think they might get some early revenue from purifying isotopes, potentially as early as 2026.
Okay, near-term potential. And the second project?
That's called Meitner. It's a bigger, later-stage plan for a dedicated production facility with 4 reactors. They're aiming to submit the construction license application for that to the NRC, the Nuclear Regulatory Commission, sometime this year, 2025, and targeting operations around 2028.
Ambitious timeline. Now back to the main Aurora powerhouses. Getting those built depends heavily on the NRC, right? How's that going, especially after their first application was denied?
Yeah, the NRC relationship is absolutely critical. The filing confirms they're actively working with the NRC. Remember, their first application, the CLA, was denied back in 2022, but without prejudice, meaning they could try again.
So are they trying again?
Yes. They're working towards submitting an updated CLA. And in Q1 2025, they started what's called a pre-application readiness assessment with the NRC staff. They're also moving forward on separate licensing for commercial fuel fabrication and submitted a report related to training licensed operators, trying to de-risk things.
Progress on the regulatory front, which is key. What about actual locations to build these things? Have they secured sites?
They've made progress there too. At the Idaho National Lab, or INL, they've secured a site use permit and a fuel award from the Department of Energy. They also finalized an agreement for site access and investigation work there.
Anywhere else?
Yes. They also have a land rights agreement in Ohio for potentially 2 powerhouses. And they've been tentatively selected by the Air Force for a possible microreactor project up at Eielson Air Force Base in Alaska.
Okay, potential sites lined up. What about customers for the power? Any firm deals?
The report mentions signed non-binding letters of intent, or LOIs, and master agreements. The big one people talk about is a master power agreement with Switch data centers for potentially up to 12 gigawatts of power.
12 gigawatts? That's enormous. But non-binding for now.
Correct, non-binding at this stage. But based on all these LOIs and agreements, they estimate their total customer pipeline is around 14.1 gigawatts, a huge potential market signal.
Definitely signals interest. And how about the fuel development itself, the specialized fuel for their reactors?
They highlighted a couple of things. The safety design strategy for their planned Aurora fuel fabrication facility at INL got DOE approval. And they also completed an end-to-end demo of their fuel recycling process with partners. They see that as a key step towards making recycling a reality.
Okay, so looking at the rest of 2025, what are their main priorities according to this filing? Sounds like a busy year.
Yeah, a very packed agenda. Key things include pushing forward with the NRC and the COLA and the fuel fab license, lots of fuel R&D and getting ready for manufacturing.
Yeah.
Working with suppliers, doing detailed engineering and construction planning.
State work too.
Yes, starting site prep at INL in Ohio and maybe other customer sites. And critically, trying to convert those non-binding LOIs, like the big Switch one, into actual binding power purchase agreements.
That seems crucial for validating the model. Anything else?
Developing the radioisotope business further, scaling up atomic alchemy production, and just general corporate stuff, hiring people, putting new systems in place. It's a lot.
Definitely a full plate. With all that activity planned, what's their forecast for cash burn for the full year 2025?
They expect net cash used in operating activities for the full year to be somewhere between $65 million and $80 million.
65 to 80 million, compared to just over $12 million used in Q1.
Exactly. It clearly signals they expect spending to ramp up significantly through the rest of the year to support all those initiatives.
Makes sense. Lastly, the filing usually covers risks and controls. What major challenges did Oklo highlight?
Well, regulatory uncertainty is a big one. Getting those NRC and DOE approvals is never guaranteed and can face delays. They're also operating in an emerging market. There aren't any commercial advanced fission plants like theirs running yet.
Right.
Then there's the sheer cost. They'll need substantial future financing to actually build these things once licensed. Supply chain issues are mentioned, tariffs, geopolitics, and just the general political climate around nuclear energy is always a factor.
And anything on internal controls, I know that's often mentioned in filings.
Yes, they did note a previously reported material weakness in their internal controls over financial reporting dating back to the end of 2024. It related to how they accounted for infrequent, complex transactions.
Is that a major concern?
They state they're actively working on fixing it, with remediation expected by the end of 2025. And importantly, they also state that despite this weakness, the financial statements presented in this Q1 report are fairly presented in all material respects, so they believe the numbers are accurate.
Okay. And one other detail mentioned was about executive trading plans.
Right. The report notes the CEO and COO adopted what are called 10b5-1 trading plans back on March 31st. These are preset plans that allow insiders to sell stock at future dates under specific conditions, basically to avoid any appearance of trading on non-public information.
Got it. Standard practice for executives sometimes. Okay, so let's try to synthesize all this. Based on this deep dive into Oklo's Q1 filing, what's the take?
Well, you see a company that's clearly pushing hard on multiple fronts, developing its core advanced fission tech, the Aurora powerhouses, and simultaneously building out this new radioisotope business via atomic alchemy.
They've got a substantial cash position from their recent market entry, which gives them breathing room.
But they're also burning through cash and projecting that burn rate to increase significantly through 2025 as they invest heavily in R&D, staffing, regulatory efforts, and initial project development.
Their build-own-operate model is distinct, and they've attracted significant, though currently non-binding interest from major potential customers like Switch.
Absolutely. But the flip side is the context. It's a capital-intensive industry, highly regulated, and still an emerging market for these advanced reactor types. The path to actual commercial operation and revenue is definitely multi-year.
And success really hinges on clearing major hurdles, getting those NRC licenses, securing potentially billions in future financing, navigating supply chains, as the risks section highlights.
Exactly. So this brings us to a really important question for you, the listener, to think about.
Considering Oklo's stated ambitions, the multi-year timelines involved, the significant and accelerating cash burn, and all the regulatory and financial challenges outlined in their own report, how might achieving the key development and licensing milestones they're aiming for this year actually translate into long-term financial performance down the road? And what are the most critical dependencies you see that could make or break that translation?